This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. Recently, I've been covering growth a lot on the podcast. Even though it's the Value Investor Podcast, growth is still on the scene. And specifically, I've talked about how value investors could buy growth and how we could even buy a stock like Facebook. Yes, even Facebook. But that's because growth is dominating the stock market. In case you haven't been paying attention, the large cap growth stocks, they're up about 14% year to date, while large cap value is up just about 4%. So that's a 10% difference. That's pretty dramatic in the first 6 months of the year to see such a big disparity between growth and value. Both are moving up, so that's good. But the breakout of the FANGs and the other high growth names on the large cap side is really dominating now. So basically, large cap value is getting crushed down. So it's no wonder that a lot of us, want to throw in the towel and quit value. We want to just be like, I'm going to go buy FANG and enjoy this rally. But not all value stocks are losing in the game. And recently, I've stumbled across quite a few that are beating the growth names. Now, they're not the big growth value companies. For the most part, at least, they're not the big growth. But there's still value stocks that are beating the real popular growth names. And I think I've mentioned in the past, a couple episodes ago, about Newell Brands. That ticker is NWL. They are one of the bigger value companies, and they're not really followed by many. Most of you probably don't even know Newell. They do own, all these like little subgroups of companies. They just merged with Jarden, who owned Yankee Candle. So they own a lot of things you could buy at like the Target and the Walmart and things like that. But yet shares are up 18% year to date. And meanwhile, a big growth name like Ulta Beauty is up almost nothing. I think they're flat year to date. So you have a big growth cap name doing not much, and then you have Newell Brands up 18%. No one's really paying any attention. So I decided to seek out other value winners this week to see if there are any that are up even bigger than the Newell Brands, up triple digits year to date, because we know some of the growth names are real hot like that. And not only did I find some big winners, but these 5 stocks are up over 100% in 2017. And again, this is July when I'm recording this, so it's only a little over 6 months of the year. They're up over 100%. And these are legitimate stocks, as I like to call them. They're not the penny stocks where you could be like, of course, Tracey, that 10%, that 10-cent stock, it went to 20 cents. So of course it's up, over 100%. These are legitimate, more than $1 a share stocks. And they have real value credentials, or at least they did when they started the year and started their rallies. Some of them are still values. So let's get right into what these stocks are, because I'm really excited about this week's episode. So the first stock is Applied Optoelectronics. I'm almost positive I've talked about them on the podcast before. If not, I definitely did a hidden gem video about Applied Opto earlier in the year. That ticker is AAOI. It's now suddenly become one of the hotter stocks on Wall Street for the year. Its shares are up 198% year to date. And they're on the cloud side of the business. And 3 of their biggest customers are these names: Amazon, Microsoft, and Facebook. So you can kind of see why they're soaring if those are their 3 cloud customers. Now, how are they up so much this year? Well, they were beaten down last year on all these fears that Amazon in particular could just basically do what they do. They could take over and do their own business on the cloud side of what they're offering Amazon. But that didn't happen. It hasn't happened the first 2 quarters of the year, and analysts don't believe it's going to happen for the other quarters of the year. Their revenue is very small for Applied Optoelectronics. It's only, I think it was like $100 million for last quarter or thereabouts. So when you're thinking about Amazon, like we just had Prime Day, and I think they made that in like a minute or something. So they don't really care to get into the business of Applied Opto. They'll just pay them to do what we need them to do. So Applied is soaring. Their earnings, last year they made $1.17. They're supposed to make $4.38 this year. That's earnings growth of 271%. Even with the shares up as dramatically as they are, their forward PE is still just 15.8. So they're still a value. Their PEG is 0.8. So they have the growth component. So they got both value and, I love it, the growth. These estimates are continuing to rise. They're reporting around August 3rd or that week of. They haven't officially announced yet. So keep this one on your radar. AAOI, they're surging towards their 52-week high again, but they are a value. Okay, number 2 is Weight Watchers. Their ticker is WTW. I was reading this book recently called The Kardashian Principle, and I know, and it's about branding. And the author says in the book that over a year ago, when Oprah bought into Weight Watchers, remember, she bought 10% of the company, she joined the board, and then later she became their spokesperson, that he said she wouldn't help Weight Watchers, that it would fail because Oprah was no longer seen by consumers as authentic, which is one of the Kardashian principles, by the way, authenticity. So he was partially true. The stock did initially falter. It rallied on the Oprah news, then it faltered. But since then, I would say in the middle of last year, it started to take off again, and sales have actually turned around. They've had several good quarters in a row. They picked up momentum on their Instagram feed, and it's not all Oprah momentum. So this stock is up 202% year to date. It's pretty crazy. It was cheap earlier in the year. It was a value stock. Its PE now is 27. It used to be around 15, and its PEG is 1.8 because these estimates aren't rising as fast as like you'll see with Applied Opto. They made 97 cents last year. They're expected to make $1.28 this year. That's earnings growth of 32%. You got to like it. Shares are at those all recent 3-year highs, actually, but they definitely have a lot of good momentum here. And if they pull back, you might want to consider them if you're really going to buy them for the value component. Now, the third stock and the fourth stock actually are in the same industry, but I like them both. Third stock is called Kai International. I know we've talked about it in the past because they've been cheap for a while. The ticker is CAI. These are the guys who lease containers. They do logistics and they do railroads. They're up 169% year to date. They're still cheap. They are trading with the forward P of 11. They have a PEG of 1.3. They recently gave an update for the second quarter ahead of their quarterly report and said utilization for third quarter is basically above 98% for their containers. So it's 100% almost utilization on the containers. Demand is really strong. No one's really building the containers. So this is a good sign for the global economy. They made 46 cents last year, expected to make 208 in 2017. That's up 352%. So you got the great earnings growth. That's why you got the low PE still, even though shares are up 170% year to date, basically 169. And you got to like these container companies because this is a sign of the global economy improving. That's ticker CAI. And the other one, the second one, is called Triton International. These guys are the largest container company in the world. So even bigger than Kai, and they don't have the rails or the logistics side like Kai does. So they're just straight containers. They are up 107% year to date, and their PE is just 13.7. So they still are also a great value stock. Their PEG is 1.8. They made 87 cents last year, and they're expected to make, with the consensus this year, of $2.50. That's earnings growth of 174%. So also great story. They haven't come out yet and said anything about the coming quarter, but if Kai is seeing those kind of utilization rates, you can bet Triton is too. And if you're like me, don't confuse Triton International with Titan International, because I do in my mind. Titan is the one that makes the wheels and the tires for like the big equipment, the farm equipment and construction equipment. That's ticker TWI. There's also Titan Machinery, not to confuse you even more. That one is TITN. Triton here, the container guys are TRTN. Titan Machinery is on the ag side. So they all sound kind of similar, but Triton is the one you want. And our fifth stock is one that I had no idea about, kind of came out of the blue. And I'm kind of surprised until I started drilling down more into it that this one is up as much as it is. So it's Kemet Corporation, KEMET. And they were founded in 1919. So this is not like a new company. And here's what they do. They supply electronic components, including capacitors, electromagnetic compatibility, sensors, and actuators. So I'm like, what? Like, what is all that stuff? I have no idea. Sounds kind of boring to me, doesn't it? Like, capacitors, it sounds like it's, the grand flux thing or whatever that is they used in the DeLorean, right? That's the only thing I can think of. Maybe they made something like that. I don't know. But when you go to their website and you look around where their products are going into right now, that is in all the super hot areas. So the Internet of Things, the virtual reality, any kind of computerized healthcare, the autonomous vehicles, drones. These components are going into all those things. Amazon just sold its number one product on Prime Day was that smaller Echo. Their components are going into all these things. So you can see now why the shares are up 122% year to date. They made 35 cents last year. Consensus for this year is 88 cents. They did acquire another company to grow the business. So that is playing into some of the higher consensus numbers because that's 152% growth in earnings. But I like it that they're growing the business. They're expected to grow earnings another 20% next year. So if you want to know kind of outside of that M&A, they're still seeing the double-digit growth. Their PE is 16.4, which I consider to be pretty cheap, again, considering the shares are up so dramatically. And we'll see what they say on earnings. They're expected to give earnings at the end of the month, around the 27th. They haven't confirmed that date yet, but around the 27th. So with all these companies, we're going to learn a lot more about what's going on in their underlying markets very soon. In the next couple of weeks, all of them are reporting. So other than Kai, which has kind of already told us how good it's going to be. So I looked at other hot and cheap sectors too to try to find this list because I know some other value stocks are doing really well right now. And that's especially in the semiconductors. I own a couple of those in the value investor portfolio. So I went to go look, were they up 100%? I didn't think so. I know some of the ones I own aren't, but I wasn't sure. And they're not, but you're still seeing many gains of around 40% for the semis. And I've talked about some of those in the past, like Micron, which is ticker MU. Some of those are up pretty big, and they're all still very cheap. Some are trading with single-digit PEs on the semiconductor side. So those remain value stocks as well, and you might want to check out some of those sectors when you're looking around at some of these. And I know people get real nervous when they see stocks with gains like this. I get a lot of questions like, oh, Tracey, it's up 100% already. Why should I get in now? I've missed it. I've missed the gains. But when you have value here, you still have great fundamentals, and those earnings estimates are still rising. That's what I want to see. I want to see those earnings estimates growing and the sales growth growing, because that's the positive things going forward. So just because it's at that high and it's already had this big run doesn't mean it doesn't have further upside. Believe me, I added Weight Watchers to the value investor portfolio several months ago when it was at the high then. And I was nervous about it. I told everyone, I don't think we're going to be in this real long because it's already near the high, but it is a value, so we're going to get in. And then I added it to the insider trader a couple weeks ago as the insiders were buying on the highs. And again, I said, this is on the highs. It's hard to buy this after this big run it's had, but we have seen further upside. Now, maybe that's just luck on that one. I don't know. It is a little pricey here for Weight Watchers, as I've said earlier. But a lot of these, it is hard. It goes against the value investing principles. A lot of times, a lot of us think value is cheap. A stock sell-off, not value with the momentum and the growth. So these 5 stocks have it all. Weight Watchers is the only one that's a little pricey right here. But the other ones all still have their value fundamentals. Weight Watchers kind of outgrown it for right now, become just much more of a growth stock story right now. But these are all ones I would keep on my list and to watch. And remember, you don't have to pay the high multiple sometimes to get these great performance, because all of these are outperforming the Facebook, the FANG stocks, NVIDIA, all of those for this year to date. So nobody's talking about most of these, maybe with the exception of Weight Watchers. Nobody's talking about Kai or Triton, Comet. I didn't even know about Comet. And Applied Opto is hotter because of the cloud area, and it's in that fun area. So keep these on your list. Let's recap the tickers again. You had Applied, Opto, is AAOI, Weight Watchers, WTW, Kai, CAI, Triton, TRTN, Comet is KEM, and Newell, if you're interested in that one, NWL. So keep these on your list. And as always, check out our prior podcasts. You can get them both on Apple Podcasts or /iTunes, as we all know it. And the Value Investor Podcast has its own page over there, so you can subscribe if you only want the Value Investor Podcast, or you can get both under Zach's Market Edge, also on iTunes. And of course, you can subscribe on SoundCloud, and that's an easy way to get us every single week. So I'll be back again next week with some more value stocks.